Hello folks, it's Shooter. Hey, we're going to go over labeling in 2023, just some changes we've made. Of course, at the end of this presentation, please do review our disclosures.
Jumping right into it, I'm going to start with a blank chart. I want to come out and I find that DuPont is a great chart to look at as far as history, sort of explain how we've moved up over really since 1973. Now, first of all, I view Elliott Wave
cycle program. So our trough, peak, trough.
So the reason I'm doing this is how I've attached my Fibonacci to Elliott Wave. And I've come up with my primary wave setups as a result. It's really just a simple way for me to be able to duplicate what I think will happen in the future. Now, part of the reasons I've done this is over time, I've noticed that those peaks typically increase over time. Over time, that sort of give you a visual about what a stock is doing. Now, obviously, this has been a significant uptrend since 2008. So when we put in that lower low, the 1972, and a lot of people don't realize, DuPont's a beautiful looking chart here at this point, just for that reason. So we can come in and say the 1972 low was here, and but we did back test that low. So, I mean, it's a beautiful looking chart from the purpose of Elliott Wave because it gives you a visual of how these cycles duplicate themselves. So, ultimately, we're looking for a little bigger cycle from where we are now. So my assumption is we would be out something maybe like this. Could also be very quick, but it should be a little higher cycle on this trend line that we have down here. So in structuring setup, I'm doing this because I want you to visually understand properties that I use setting up a Elliott Wave count where all the triggers are. So, I would be looking for something to come in where the higher low is somewhere around 50 and the higher high would come in somewhere around where our counts are. Now, there's two possible outcomes here. We have, of course, to the upside here, it's extended. We also have a possible upside here. Now, some people use 3 tags of a speed line, support and resistance line. Consider it support and resistance. Honestly, not critical for me in my work because I'm looking for equality. In other words, this count, I want some equality, when I look at that. So first drive, second drive, I'm looking for a third drive. Reason is I've learned that 3, 5s, and 8s are important in Elliott Wave. So that's how I'm doing it. All right. And I don't know that anybody's complaining about my work yet. So I'm really off base. But let me jump into, now I'm going to bring in some Elliott Wave counts and I'm just going to bring it to a weekly chart. Okay. So a primary wave is a primary wave degree or above. All right, so primary wave are green labels, cycle waves are blue labels, super cycle labels are purple labels. Right now, intermediate waves are this light gray, minor waves are the blue, and then the minute waves or minute waves are pink here in this chart. They go, there are some additional wave degrees that we've never seen. Grand super cycle. Super cycle includes the Great Depression. Grand Supercycle I've never traded. Obviously, Submillennium I haven't traded, and obviously Millennium I haven't traded, and Super Millennium I haven't traded. We focus around primary, intermediate, and minor. That's pretty much where all my work is. Now, the one thing that I'd like to point out in this cycle, let me go back, is we have a uptrend, which is called a motive wave, and a downtrend, which is a corrective wave. Now, typically, a motive wave or an uptrend is either a leading diagonal or an impulse wave. However, sometimes they are ending diagonal. And that the difference between a leading and an ending diagonal is one is broad at the beginning and one is broad at the end. Okay. So when you start seeing broadening patterns, you're looking at an ending diagonal. And then on the downtrend, they're ABCs. Quite often they do become 5 waves. So, you do have an ABC here. Now, the one thing that I'd like to point out is in ABCs, there are 3 types of ABCs for me. Quality, right? Something that's extended, okay? And the elongated count that we had here. So in this original count, just to get this noise out of here, we're going back to the original count. In that ABC down, right? We've had probably a 5 wave down here, an ABC here, and then 5 wave down again, maybe even an ABC here, and then we're going to put in our 3, probably a 5 wave there, and a 3 again. So ultimately, that's 5, 3, 5, 3, 5. Okay, and the count patterns are consistent because once when you can see that, then you can really more confirm the trade. But for the moment, you're going to see a primary wave setup when it comes to the chart. Now, I post only primary waves with a 90-minute trigger in the primary wave setup article every week. You will just see a primary wave label long, and then we will go down to our 90-minute, one day here, and we need to add my template here which is a strategy that I've added to my work. So I don't know why it does it in after hours. Data just is not always favorable. All right, so our trigger is here for our 90-minute off of our B here. Hopefully I'm correct. I don't even see my... Where the heck over there? Now I'm just going to go with this for the moment and see where it lands. All right, we're going to say this is our 90-minute trigger. Come back to our weekly. Way the heck over there. Nope. We're going to come down here and just guess where it is. My data is not going to give it me. On the 90-minute trigger, when I post a primary wave setup with a 90-minute trigger, the idea is that you enter with a quarter position. Then we wait for our daily trigger, which obviously we're going to get a daily trigger just above this, and then we add another quarter position. So typically, and the reason I've set this up is it's sort of time consistent with how we're posting the articles. So usually the 90-minute trigger goes this week, the daily trigger goes next week, and then we come out to the weekly, and we get the weekly trigger with the strategy. Then, obviously you're at 3/4 of position. So on the 90-minute, you add a quarter. The daily trigger, you add a quarter. Weekly trigger, you add a quarter. And then when it breaks out, which in this situation, the breakout line would have been way the heck down here on this particular label. And I'm using this label because this one sort of cuts off on where our breakout would be. So our breakout would be just a little bit above where we had our weekly trigger. So in that situation, you now have a full position on, and that is how we scale in. That's the intent. So breakout, boom. All right. Now, typically we're going to run until we have completion. Now, sometimes we will take partials on A's where we have huge resistance like here, maybe cut, take half profits. Now, quite often what I do is I come in and I put 1 or 2 contracts where I sell puts, and roughly I'm targeting whatever I can get a good premium on between the 32 and the 28. And then I will buy 35, maybe even 40 calls with a piece of that. Okay, wait till my next trigger comes in and my daily trigger comes in. Now I may add selling some more puts, maybe around 32 or 30 here, right? And then roll up and sell 40, 45s. So I may have multiple positions here, and I'm not posting all of those in the room when I enter a particular symbol. I am posting setup, and I'm saying sell, a $27 put here. The reason is I'm being more conservative in fundamental trends than I trade myself. I'm pretty aggressive at times, and, we're not trading short, and we're not day trading. So, I'm day trading, but I don't necessarily, the room is not going to day trade. So now at that point, typically your prior low is what I'm going to post as a stop. However, if the chart doesn't need a stop and it's just what it is, then I'm not going to put a stop on it. And the reason is because some charts don't need stops. We don't want stops because it's acting too well. It's too euphoric coming out of here. This situation, we have this leg down from 110 down to 30. So we got a $70 range, 50% back, $74. I am not going to worry about a trade having a stop when at 50% back, 70%. If I take 25% of that, I'm looking at 45 or 50 as far as a target. Now I'm going to follow those counts and I'm going to look at them every week, maybe a couple times in the middle of the week. I look at Monday, Wednesdays, and Fridays, around noon to the close. I will review all the charts and look at what those numbers are. But that is how you scale in. Now, I'm going to jump over to the right side of this chart, and I'm going to show you how our labels are. Now, right now, we have account 2, and we're heading to account 3. So this is our channel that we are in. Boom, that little channel. All right. So my next target now is my 3. So you will see a label that says target 1, right? Now, when this 3 back test is our 4, so that is a back test. That will be a red label. What I'm trying to do is give you an idea of how Elliott Wave stair steps and how I'm helping you structure your trade so you know where back test might be. Now, assuming that's equality, in other words, it's equal to this move. That means if you have an extended back test, go to here, and an elongated back test can come all the way back down here. As long as it doesn't get below our 2, we shouldn't be concerned. You may trim if it breaks below that 2. But me in this situation, looking at where my moving averages are, I would like to close below the 200-day for me to cut. So, in that situation, just giving you a visual of where we might be. And then in the circumstances where I think we are going, I will post a target 3, but I'm typically not going to post a target 3, $100 up from where we are, because sometimes these counts measure these whole legs. And I don't want you to be that euphoric. I want you to be conservative in how you look at this. In this situation is we had a higher high, lower high, lower high. I want to come in the middle and say, hey, my target 3 is probably right here. All right, you're just giving you a visual. So when a target is below the count, know that I'm posting something that's conservative. So we're trying to keep you in the money. Just like scaling in this fashion is being very conservative because, quite often when, and I don't know in this situation, this might have been our primary wave setup, okay? And this might have been a divergent low and a divergent low, which it was, okay? So typically,
Well, the
you
primary
have
wave
your
setup
par,
doesn't
one standard
exceed
deviation,
two standard deviations from the first
three
count.
standard deviations. So if this was our first primary wave setup, we extend. I'm always looking, I'm like, hey, this could extend to that third count that I'm looking for, and I'm looking about how far is that count going to be. So in this situation, here would be count 1 for me. This would be count 2. So count 3 could be way the heck down here in that situation. So when I'm structuring my trade, I want to understand where we could possibly go if primary wave is wrong. Now, it's not wrong 30% of the time. I say it's valid 70% of the time. It's actually a little higher than that. The way that I think of this is I'm trying to make sure that we have the law of averages on our side. So once we get to the first primary wave, it depends on how it finishes. When we have this exhaust, and we've confirmed, and it's a very significant confirmation, to me, that's a good spot if we get a primary wave, especially by the time I get up to the weekly trigger and I've added here and how aggressive that push was. It's telling me we're back testing 50% of the move. Where'd we go? We went right to 50%. We actually went above 50% of the move. 50% of the move was here. So we got the 50% back. So I'm conservative when I say, so if it overshoots, that's even better. But at the same time, if we overshoot 50% back, I pretty much could have predicted that we would have had a pattern break back down, and we should back test primary wave like we did here. So ultimately, that's the targeting scheme that I'm using, with the primary wave setup. We're going to be adding a number of charts this week to the grouping, and we're going to probably be adding a number of intermediate wave continuations in swing trade notes. I'm not ranking those individual positions, but there are some stocks I like because of the volume in the options, and how active those are. When I see unusual options come in addition to other technicals that I'm looking at, I would like a stock to ultimately push the bottom like this is done. Then I'm looking for a bounce. Then I'm looking for a squeeze out of it. And those are what I love to trade. Now, this is how I come in and add our Fibonacci extensions, which are an important part to my work. So for the upside, I'm going to measure the entire cycle. And this is the entire sanity of why I started with cycles in the first place, because ultimately, Elliott Wave is the cycle program, and almost every other strategy some way attaches Fibonacci's cycles and Elliott Wave. A lot of people are trading other technical indicators, and they don't realize how interconnected they are. Because ultimately, the person who designed those indicators, all of what I've just gone through into consideration before they designed higher lows, et cetera, firmed high, divergent high, right? Now, in that situation, broke down on the second. Now, topping patterns, bottoming patterns, we have two formations, XABCs or 3 drives, right? Now, I happen to mentor with Dale Pinkert, the best 3-drive expert on the planet. He's been trading over 40 years or close to 42 years, I think. And he was on the CME floor, where he traded the oil puts. So he's in commodities and currencies. He does not generally trade equities. I prefer. However, his work is a lot of how I get my fundamental, my macro, and my micro view on the markets, because I look at the international markets a lot, currencies that lead to where I think equities are going, which I think gives me an advantage in that opinion, when I do draft my work. So those are the primary labels that you're going to see. What you will also see is when we have a minor wave that is a continuation in an existing primary wave, and I'm doing this for the people who just entered the group, is really the intent here. You may see a label that selects the intermediate long. Let's say you jump in, you bought our service, you're looking at it, we had a primary wave of entry, and we've had all these entries trigger over here, and you missed it. Well, when do you buy it? Well, that's exactly what this is there for. It's to give you a later entry if you take a position. Because honestly, your book might be full. You might have all these full positions, you have no money left to put anywhere. And something may get closed out, and you really put DuPont top of your list after your own analysis, and that's where you add it, right? So, well, that's what I have, folks. Great trading. Until next time.